Welcome to ForexTV.com. Today's Tuesday, July 8th. I'm Remy Hookey for New York Forex Market Buzz. The U.S. dollar is holding on to session gains against the euro, cable, and the yen. The U.S. dollar strengthened following this morning's comments from Fed Reserve Chairman Bernanke. And taking a look at the latest headlines from the CEP News Desk, North American markets received disappointing U.S. pending home sales data and slightly higher than expected U.S. wholesale inventories. But markets were preoccupied with the pullback in crude oil as well as other commodities. According to the National Association of Realtors, U.S. pending home sales resumed their decline in May, falling 4.7% after an upwardly revised 7.1% bounce in April. The prior month's rebound was an unexpected increase that followed an all-time low in March. Meanwhile, U.S. wholesale inventories rose 0.8% month over month in May. The previous month's figure was reversed to a 1.4% gain. Since April of 2007, inventories have increased by 8.7%. Meanwhile, Fed Chairman Bernanke said the Federal Reserve may extend Wall Street's access to lending until 2009. Speaking at the FDIC's Forum on Mortgage Lending in Arlington, Virginia, Bernanke did not speak on economic outlook or monetary policy, but he did say Congress may have to heighten its oversight of investment banks. Overseas, the G8 summit in Hokkaido, Japan concluded. The world leaders agreed on the need to stabilize the global financial system and on the fact that the global economy is slowing as a result of inflation from rising commodity prices. The leaders said they believe in the ongoing resilience of their respective economies and that the overall economic outlook was positive. G8 officials also expressed concerns over the high price of oil and food, urging increased refinery capacity and crude oil production. This afternoon, I'm joined by Brian Dolan, Chief Currency Strategist at Forex.com. Good afternoon, Brian.
Hi, good afternoon, Remy.
Thank you for joining me today.
Pleasure as always.
Now, although the data front is light here in the U.S. this week, Fed speeches, the broader market, as well as a pullback in commodities will remain in focus. The U.S. dollar is seeing gains versus the euro, yen, and pound today, while the market weighs the Fed's response to the housing crisis. But we're still seeing range-bound trading in the majors. So while no single theme has dominated the fundamental front, what is your technical forecast for euro dollar?
Certainly, the euro dollar's worked itself into a pretty clear range, and the upper level was seen just late last week, up around the 159 area, and then the lower level is down at the high 152, low 153 area, and we are right in the middle of it now. And the 155, basically 155.60 to 156 to figure area is shaping up to be the key pivot point that would allow the euro to go down and test into the lower end of its range, which is ultimately where I think it's going to be going over the next several days to week. That level has a number of different supports coming from both Ichimoku charts, as well as the 21-day moving average is down around 156.17. The 55-day moving average is about 155.94, and then the 100-day moving average is at 155.60. So that's the pivotal support level. That if we get below that, I think we'll take a dip back down to the lower end of the range, high 152s, low 153s. And the main basis for that, on the fundamental basis, is Eurozone data has taken a sharp deterioration lately. U.S. data, while it is still weak, is not really dropping precipitously, and so a lot of the dollar weakness is already priced in. So that, as well as the G8 support for basically limiting further dollar weakness and preventing further dollar weakness, is, I think, going to keep a cap on the euro at that 160, 159 area. So I'd like to look at the downside and sell euro on strength.
Okay, Brian, now that we've covered euro dollar, let's move on to the yen. While we keep our eyes on developments in equities as well as bond markets, let's take a closer look at the Japanese currency, which continues to respond to external factors as opposed to internal, as we continue to see weak Japanese economic data. So for the low yielder of the yen, and also while we're at it, also the Swiss franc against the U.S. currency, what is your short-term recommendation and forecast?
For dollar yen, the key level there has been the 200-day moving average, which has managed to contain the upside for dollar yen on a daily closing basis for the last several weeks. And that level today comes in about 107.60. and so I look for that to then continue to hold. But I think you were right in your comments at the top of this interview that the commodities are really one of the big drivers. And while oil and generally commodities they look to be putting in a pretty significant top at the moment, that also supports the idea for a stronger dollar. And if we should get over the 107.60 and close above it, that 200-day moving average, I think we're looking for dollar yen to extend the gains up into the 109 to 110 on the follow through there. And then while we hold below the 200-day moving average, we look to have a pretty good floor in around the 105.5 to 106 area. So within that, we're still looking at a pretty much of a range environment.
Okay, Brian, now that we've covered the euro and yen, let's take a look at the sterling. While the U.S. dollar is seeing gains, cable is holding below 197. The Bank of England's policy meeting and rate decision is coming up on Thursday morning. So for the UK currency against the U.S. dollar as well as the euro, if you could briefly give us your fundamental take as well as your levels.
Sure. The pound, I think, has suffered another rejection from the 198 area, and this is due to very weak British data coming in lately. We had the sharper than expected drop in industrial production on Monday, and then overnight we had the British Chambers of Commerce announcing a very sharp decline in sentiment, particularly in the service sector, dropping from plus 17 to minus 2, taking it back down to levels not seen since 1992. So the environment in the UK is shifting as of several weeks ago, with the Bank of England pounding the inflation fighting drum. Economic weakness has come back, I think, into the foreground, and the market is going to spend the next several days and weeks pricing out the prospect of higher UK interest rates, and very likely pricing lower a further cut once inflationary pressures begin to subside. So I think it's going to take. I think that also keeps the focus on the downside for the British pound, and the 196.5 area is the trigger to further losses in the British pound. So I would look for a move at that point to follow through down to about the 194.5 to 195 initially. So basically like to sell sterling on rallies anywhere north of 197.5 and basically 197.5 to 198.5.
Okay, Brian, now very quickly I'd like to shift our focus over to the dollar block currencies of the Aussie and the CAD. We will be keeping an eye on the broader decline we're seeing in commodities, but has your short-term forecast changed for the Aussie and the CAD, and what is your recommendation for traders of these currencies?
Yeah, I think there have been some shifts, and they're very subtle, but that is basically the environment that we're in these days. With a lot of bad news out there, the market is trying to just hang on to some trading idea for any length of time. So for the Australian dollar, the shift takes the form of expectations of further tightening from the RBA needing to be taken out of the market. We just had another sharp decline in Australian NAB confidence overnight, so that surprised to the downside. And the fact of the matter is the RBA has been successful in terms of reining in domestic demand and basically slowing the economy. And the situation they find themselves now in is one of where slowing growth fears, I think, are beginning to outweigh inflation concerns. So I think interest rate hikes from the RBA are being taken off the table, and so that again exposes the downside for the Australian dollar. The immediate level to keep an eye on is just below current levels at 94.80 to 95 the figure. That has been a series of recent lows since the middle of June. And then looking at the chart as well, I'm looking at basically a double or triple top in the very short-term type pattern. So that again argues for the downside, and I think once we see below that 94.80 area, the downside we'll see relatively quickly back down to the 93.5 area. And then for the dollar Canada, another very interesting shift has taken place, and again this also traces back to the fundamental data, which just a matter of 2 weeks ago or 3 weeks ago, the Canadian data was coming in much softer than expected, and then just over the last week, Canadian data has all of a sudden come back much stronger than expected, and this coming on the heels of the Bank of Canada essentially saying that they're not going to be cutting rates any further. So I think that is one of the reasons that even the decline in oil has not seen the Canadian dollar weaken very significantly. But ultimately, I do think the oil dynamic will lead to a higher dollar Canada. We're just talking about the better Canadian data for the time being, for a very short period, bolstering the Canadian dollar and preventing it from weakening as much as the oil price drop would suggest. So ultimately there, I'm looking for a move back at the minimum to the top of the recent ranges in the 103.5 area, and a clear break of that level would trigger a move back up to the 104 high 105 area. So again, not a major rally for the U.S. dollar, a major decline for the Canadian dollar, but still exploring within the recent ranges.
Okay, Brian, thank you very much for joining me this afternoon, and thank you very much for your insight and analysis.
Thank you, Remy.
Thank you. This has been your Forex Market Buzz with Brian Dolan, Chief Currency Strategist at Forex.com. I'm Remy Hokie. Join us later this afternoon, 4 p.m. exchange, right here on ForexTV.com.